All right, Roth. Who is Roth anyway? Roth is William. He was a senator. And in 1997, somehow managed to get his name on a piece of legislation that introduced the Roth IRA. And so it's not an acronym, it's somebody's name, ROTH. That's where it comes from. Subsequently, a few years later, I think it was about 10 years later, you started being able to have Roth 401ks and 403bs. And all Roth means is tax-free, meaning you put after-tax money that's already been taxed into the account. And when it comes out, it doesn't get taxed again. Grows tax protected. When it comes out, totally tax-free, no matter what you spend it on. Now, like any other retirement account, it usually has rules. It's supposed to be for retirement. So if you take it out too early, you might have to pay a 10% penalty on it, unless you meet one of the plethora of exceptions there are to that penalty, including early retirement. Typically for 401ks and 403bs, that's 55 and separated from the employer. For IRAs, that's 59 and a half. But like I said, there's a long list of exceptions. Usually, early retirement or concern you might need the money early is not a good reason not to save inside a retirement account when you otherwise can. For 2023, you can put in $6,500 into a Roth IRA. Most of us are having to do it indirectly via the backdoor Roth IRA process. You can do that for your spouse as well. They probably also have to do it through the backdoor Roth IRA process. If you're 50 plus, 50 or better, maybe that's the way to say it, it's $7,500. You can also, totally separate limit, you can put $22,500 into your Roth 401k or your Roth 403b. If you're 50 plus, 50 or better, that's $30,000. Okay? And in fact, the total amount that can go into that account is also a little bit higher when you're 50 plus, because that catch-up contribution is in addition to the 415C limit, aka the $66,000 per unrelated employer retirement plan limit. If you're lucky enough to have a 457B, there might also be a Roth option on that. Again, another $22,500 that you can put into that. Our Secure Act 2.0 legislation has brought up all kinds of other Roth possibilities that are going to be coming down the pike. This includes Roth SEP IRAs, Roth Simple IRAs, and even Roth matching contributions for employers. Now, most of us are still trying to figure that out. If you're an employer or you're a retirement plan provider, you're still trying to figure this out. And I don't even know if it's going to be done by the end of the year. I kind of thought we'd start seeing it by now, but I haven't seen anybody offering it yet. But it's supposed to be legal starting this year. Anyway, lots of cool things you can do with Roth. One of the most difficult decisions is when you have the option where you can do tax-deferred contributions or you can do Roth contributions. The rule of thumb is that you do tax-deferred contributions during your peak earnings years and Roth contributions in other years, like when you're a resident or a fellow, or that half a year after you come out of training, or when you go on maternity leave, or when you cut back later in your career and now you're working part-time. Those sorts of years you do Roth. But there are lots of exceptions to this rule, one of which is being a super saver. If you're saving so much money that you're going to be in a higher tax bracket in retirement, you should be doing Roth savings now. Another exception is people that are expecting a big pension, like a military member maybe. You're in this low tax bracket all the time you're in the military, and then when you come out, you got this other pension, and you end up in a higher tax bracket. So Roth contributions are right for almost all military members as well. If you just expect a whole bunch of taxable income in retirement, maybe from a real estate empire you're building or something, they can also be a great option during your peak earnings years, even though you're paying a lot of tax on getting that money in. But everybody else, the rule of thumb is peak earnings years are for tax-deferred contributions.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.